I think when it starts with our evidence-based work, we put a lot of weight into understanding demographics and then the role history plays, like in each context. But I think it is one of the really misappreciated things that demographics really explains almost every bull market since 1890, actually. So if you followed every generation, the gaps between the generations are really where the bear markets exist, and the bull market tops coincide with the peak of a generation. So 99 was the peak of the boomers. 74 was the peak of, I think it was called the generation before the silent generation. Gen X peaked in 2018, and millennials will peak in 2035. So those are like rough waypoints for when actual major tops take place. I think the second thing that we found is investors, as they age, become wealthier, but then they become more skeptical. And so most of the wealth in America is held by older people, including institutional managers, right? They're over age 40. But the world in disruption is caused by young people. So I think investors tend to think their own wisdom drives the economy, and it's actually, they need to put on the lens of a 20-year-old. That's what we do at Fundstrat. We survey constantly, so we think about what young people are doing, and they drive ultimately the markets and economy. And the third thing is, I think we don't lack recency bias. Like we turned bullish at JP Morgan on February 2009, and we identified upcoming low that would look like 29 or 74.
Which was the following month, right?
Yeah, it happened. Yeah, so we were a month early. So we suffered a drawdown.
We'll allow you that 1 month error.
Yeah. But what was interesting is that people were skeptical because that generation of investors just went through the dot-com bust and now the GFC, so they were now equity skeptical. So they couldn't imagine anyone would want to own equities for the next decade. But that bias is the reason why stocks can positively surprise. And so and even most recently, I think there's a bias now of people having a pessimism about inflation and pandemics because we did suffer through 5 years of that. But that's causing people to now be skeptical of the world because that's in their bias. And so I think we're judgment-free that way. People call us permabulls, but it's really more we're judgment-free.
So in terms of where we are right now, I mean, you said 2035 there on the demographics. Are we very early in a new bull market? But we've obviously had a extended bull market already.
Yeah, I think that's what confuses folks because I would say generally we've been up since 2020, but we've had two 20% declines since. So in fact, this has been a really disrupted recovery since the 2020 lows. And so I think we are in a new bull market because we just had another essentially wipeout that happened February to April this year. I do think that the bigger story arc is that there is a big surge in U.S. prime age workforce. That's the millennials and Gen Z. Plus, they're inheriting a lot of wealth over the next 20 years, which is going to be transformed into more equity exposure, less credit. And the third is that the U.S. is at the center of a lot of the major structural changes taking place, AI and now blockchain. But those are going to really boost financial sector, which could re-rate to like 40% of the S&P. And then, of course, healthcare could benefit. So I think there's a lot to be excited about. And 2035 sounds about right. That would be a 10-year bull run from here.
In terms of the risks that are out there, and we've had Jeremy Grantham on, we've had Ray Dalio on, so we've touched on some of these. But are you not concerned about, let's talk of the main one of the week, Fed interference, for example? Or if anything, does that spur equities potentially?
Yeah, I mean, Wilfred, Fed independence is really important because the Fed is the single most powerful entity in the world, right? Because what the Fed says triggers an instant response across all markets and CEOs and policymakers everywhere and even government. So that being independent is critical. I think that we're going to ultimately find that the administration does accede to what markets rationalization is, and I think the markets don't want to see a non-independent Fed. So I'm going to lean towards the idea that Fed Chair Powell serves his term. But even if it's just noise now, it is just someone, it comes across as more not happy with policy, but they're not going to interfere.
So similar, I guess, that the markets forced the hand after the tariffs a little bit. What about the headline debt to GDP aspects that we talk about a lot?
Yeah, that's a problem. I mean, if you don't put governors in how spending takes place, then governments keep expanding the pie, and we don't want to crowd out private sector spending. So I think there is a lot of negative implications for a budget deficit, and then, of course, the debt burden that comes with it. But there are a couple things I would just highlight as offsets. One is that the U.S. has a really big balance sheet that's basically valued at zero. If you compare the U.S., they own a lot of assets that other countries have already privatized, whether it's the postal system or in the U.S.'s case, even how they're valuing their gold holdings, national parks, land, resource rights. I think I've seen informal calculations. This does come into the tens of trillions of dollars. So the U.S. is a lot less indebted than it looks. And the second, of course, is if the dollar's dominance is set to grow in the next 20 years, then this is not a problem. So it really comes down to whether dollars are being more accepted over time.
But just to put those two last questions together, is there a level of longer end rates that maybe more of a trading call as a short-term call that makes you bearish on the stock market?
Yes. So we look at the general relationship between yields and PE or risk premium. You can use any metric, and it's not a linear or even exponential relationship. It's actually dynamic. So below 2%, when yields are below, and this is pretty true with most countries, PE tends to actually decline the lower the yields go, because it's more of a deflationary environment. But between 2 and 6%, higher yields are associated with rising PE. Because I think that, and I've seen academic work, generally somewhat higher elevated nominal growth and even nominal inflation, 3%, is good for corporate earnings, because companies can out-earn that cost of capital. Mm-hmm. So PEs tend to rise. So between 2 and 6%, you'll actually have rising realized PE. So as yields get to 6, I actually think PEs would go up. But then after 6%, of course, you start to really crowd out private sector's ability to out-earn the cost of money, so the PE should fall.
What's the bull case for JP Morgan or some of the other banks in a world which you could look at and think they're going to be disrupted?
Yeah, I think they're disrupting themselves in a way. Because, well, here's something to keep in mind. First of all, I know Peter Lynch famously said the reason he got out of Japan in the 90s was he looked at the top largest companies in Japan, and they were all financials. And so he said to himself, like, okay, wait, if it's all just financials, like, there's something wrong with that economy. And he sold Japan. But I think JP Morgan is very, and Goldman are really different, because number one, in the post-GFC period, they were highly regulated, almost forced to not make money. And they, under those conditions, generated really good shareholder return, earnings growth. So they became essentially nimble under a huge regulatory burden. And then in the last few years, we essentially shot up the economy with like inflation, Fed hikes, things that should obliterate banks, caused housing to screech to a halt that should really hurt banks, and they produced good earnings. So they've been battle tested, but we still treat financials through a 50-year story arc of their returns, and price to book governs the valuation. But now they've got two big tailwinds in front of them. One is AI, which is really going to be a tool for them to better understand credit relationships and customer relationships and even customer attachment. And of course, ways to more profitably lend and participate in markets. And the second is blockchain, which could radically reduce their cost. I know that, and I can share that during COVID, one bank told me, and I do interact with a lot of companies, because we get asked to present to the board, that during COVID, every employee had to do VPN. So they essentially have surveillance, because they know who's logging in and what keystrokes they're doing. 80% of their employees did nothing during COVID. So they still made good profits, but they know that 80% of their employees did nothing. So the banks know they can re-engineer their entire operations around AI and blockchain. JP Morgan could have more profits, but the biggest cost in their business is employees. So that means if you shed employees, then it's shareholder return that benefits.
Back to the broader markets, because you mentioned earlier the critics who have tried to throw mud, and you've been right for 12 years, sometimes use the label perma-bear. Slightly different question on that, but I wonder, and it's certainly in the entire time we've known each other, being bullish has worked. And I give you 100% credit for that. But do you think your style, your personal style, and emotion is clearly relevant when it comes to markets? Do you think you'll be able to call the end of the bull market? Do you think your style is better suited to bullish momentum or not?
That's a great question. I can say that in '99, when I was a technology analyst and covering wireless, and that was living history of a bubble that really was a lifetime bubble. Mm-hmm. I think if people weren't in that period, it was 5 years where literally if someone said buy the stock, it could go up 20% in a week, and then it would still keep going up. Mm-hmm. I mean, that was really a different era than anything we've seen today. But in '99, it was clear to me that we were in a bubble. And I was only in my 20s. But I was at an investment bank, and they kept telling me, Tom, there's this $5 billion IPO, and we need to be the book runner on this deal. So you need to tell them we're going to recommend this stock. And I said, there's no way. I can't. I mean, this business model makes no sense. And so I was not popular with the investment bank, but I passed on so many deals that wanted to do multi-billion-dollar IPOs that would have been hundreds of millions of dollars of fees for the bank, and I would have made tens of millions of dollars because at that time they were paying you for your IPOs. So I, with my own reputation at stake, I avoided the implosion. As you know, when that telecom internet bubble burst, many people's reputations got destroyed. Mm-hmm. Mine actually rose. I was still famous as a wireless analyst, but then I got promoted to be a strategist because I avoided all of that carnage. So if someone's asking me would I know what a top looks like, by the way, I also had a very famous short, a sell rating on a stock during that era that almost destroyed my career because the company was so angry at my not recommending them that they even complained to the SEC. And my company at the time, it was written up in the journal, so someone can look it up. I'm
going to. Maybe we won't add it in the show notes, but I'm going to look it up.
I don't want to name the company, but they were so... Apparently the CFO said he'd wake up angry and yelling about me mm-hmm. because I wasn't recommending a stock. So there's enormous pressure, and I still kept a sell rating. So I know what a top looks like. Now, I think one of the things that helps us at Fundstrat is we have Mark Newton, who is a technician who does really good cycle work, and he calls...
What's his handle on Twitter again? Because he's great to follow.
Yeah, at Mark Newton CMT.
Yeah, it's great.
Like
great
country
account.
Music technician, I guess, because he does like country music. But he was dead on in 2021. He said that we were nearing a top. I kind of didn't understand how dire his warning was because we had the 2022 drawdown, mm-hmm. and I said, Mark, listen, next time you got to just really turn off my screen when you're telling me this because I didn't appreciate the level of the warning he had.
What is your overriding piece of investment advice for our listeners?
I think the most important thing I'd emphasize is that when you're investing, you should really think of it more as you're buying companies, not just buying the stock market, because then you'll have a lot more conviction about what you own. I think when people really understand Tesla or Palantir, and then they don't worry about tariffs and inflation because they know these are really smart companies. So I think if the more they believe it as a series of companies they own, the more likely they're going to hold on to their stocks.